corporate finance, accounts receivable financing. Don't leave profits solely to chance. Instead, use corporate finance. Accounts receivable financing. So this is another financing option. When we're thinking about financing options, we're trying to increase basically the cash flow. We're trying to get the money so that we can reinvest it in the business and grow the business. Noting that accounts receivable is, of course, an asset. It's an asset that represents sales that we have made that we have not yet collected on, and we expect to be collecting them in the future in some way, shape, or form. We can use that in a couple different ways, which we'll discuss shortly, to finance more funding. The advantages of doing so would be that it allows the borrower to reinvest as assets expand. Meaning, if we make sales, for example, if we make sales on account, then we have not yet got the money. If we made the sales for cash, we'd have the money. We can then increase the cash flow. We can put that money back into the business. If we then get sales, but we don't get money, we expect to get the money at some point in the future, but it's not going to be for another 30 or 60 days, then one problem, we'd have to wait for that time period to pass before we can use that money to further increase the business. If in some way, shape, or form we can get paid sooner by possibly selling in some way or getting a loan against or something like that, the asset of the accounts receivable, we can get the money as the assets grow. As we make the sales, we can reinvest that sooner into the business and possibly grow faster in that way. The disadvantage, of course, is that it can be expensive to get funds by doing some type of sale of the accounts receivable or using them in essence to finance a loan. So if we can get financing in some other way, it might be cheaper. However, if we have a situation where we're growing and we're trying to grow quickly and we need the cash flow to do it, and we have a lot of sales on account, it might be beneficial in that instance for us to finance the accounts receivable in some way, shape, or form, increasing our cash flow, allowing us to grow faster. So what does it mean to have accounts receivable financing? And remember that the accounts receivable is an asset on the books. We expect to be paid at some point in the future. We just want to get the money sooner somehow. So we could have pledging accounts receivable. We can pledge the accounts receivable. We can have factoring of the accounts receivable. We'll discuss these a little bit more detail shortly. Or we can have an outright sale of the accounts receivable. So obviously if we have the asset of accounts receivable, we expect to be paid in the future. You can imagine a situation where we could basically say, hey, I'd like to sell this to another company and actually get paid sooner for the receivables. The other company then, of course, is going to say, well, I'm going to have to go through the collection process and whatnot if you sell the receivables outright. So it's going to cost for me to be purchasing the receivable. It's probably going to be a fee related to that. Or you could try to get a loan basically against the receivable and try to say, hey, look, this is an asset which we can use to help basically secure a loan. So let's first take a look at pledging accounts receivable. The lending firm will decide on the receivables it will use as collateral. So we're basically thinking we're going to pledge the receivables, use those as collateral. The firm that is lending then is going to be choosing the accounts receivable they want to then be using as the collateral. The loan percentage will be dependent on the company's financial strength and creditworthiness, which makes sense, of course. If the lender is then lending, they want to make sure, even if using the accounts receivable as collateral, that they have a good relationship, that they trust the company, and that will, have a difference in terms of what the relationship will be with regards to the loan percentage. And then the interest rate will usually be far above the prime rate. So if we're using this method, we're using the pledging of the accounts receivable in order to get financing. Once again, the benefit being that as accounts receivable goes up, we get the money sooner, we can put it back into the business, but it'll typically cost more because the interest rate will typically be higher. With factoring accounts receivable, which is kind of like selling the accounts receivable, but it's usually a little bit more complex of a problem or situation with the sale of the accounts receivable. For example, a company possibly could receive an initial advance, possibly around something like 80% of the amount of the invoice when the invoice is purchased by the lender. And then when the invoice is collected upon, the lender may pay the remaining 20%. And then there's going to be some type of fee that will be involved for this process to be taking place. So that would be the kind of general process of the factoring. Factoring can also add some complexity to the accounting process, because you can imagine the accounting process increasing the accounts receivable, then selling the accounts receivable, or factoring the accounts receivable, possibly getting an initial payment on it, and then you got to deal with the fee that's going to be put in place when it was collected on, and the added amount is basically received plus or minus the fee that would take place. So the factoring company does not have any recourse against the seller of the accounts receivable. So they're taking on the risk in that instance then. A finance company may do a credit analysis to make sure of the quality of the accounts. So if you're talking about this type of situation, if they're going to basically kind of sell the accounts receivable and they give basically like 80% of the value, then in order for them to mitigate the risk, when they're paying for the accounts receivable, they're doing so by not giving the full amount, only the 80%. And therefore, if they're not able to collect on the accounts receivable, then they're only, they're losing the 80% instead of the 20%. They're still taking on a good degree of the risk if that were the arrangement. Obviously, the arrangements could vary depending on the circumstances of the factoring arrangement. So the factoring firm takes on the risk, which then there's going to be a fee related to it. So in order for the factoring firm to take on the risk, again, they might, only pay initially for some part of the accounts receivable to be paid the rest at some future point. And then even still, of course, they're going to be charging a fee for this to take place. So once again, the factoring process adds a level of complexity to the accounting system in and of itself, and of course is costly, but it can increase the cash flow. So if we want to get that cash sooner as the sales take place and feed that back into the company to grow faster, it can be an option to do so.